Hello everyone. My name is Kamal Manocha. I represent PMS AIF World. In the rhythm of doing weekly webinars where we invite different leaders to understand what's happening in the market and also to give perspective to investors to kind of remind them, during these tough times, good times, to kind of hold on to their emotions, not be too greedy at good times and not be too fearful at bad times. And our intention is very honest, and our endeavor is quite knowledge oriented, because we're also seekers of knowledge and we want to impart the same to our clients. In that context, today we have Mr. Aniruddha Sarkar, who is the fund manager and CIO with Quest Investment Advisors. He has been leading this position at Quest for the last 26 months, and under his leadership I have seen some of the PMS strategies that Quest has been running for more than a decade have actually delivered stellar returns in the multi-cap categories. And I know Anirudh has been quite passionate about trying to identify various sectors, because we have seen that every time an equity market goes through a bull run or a bear run or a consolidation phase, there are certain sectors that are always either leading or they are laggards. If one is able to identify some of these sectors early, then trying to identify good companies, good businesses within those sectors is relatively easier. And this is exactly what is called sector rotation strategy. For example, I can tell you, going back to my older years when I started my career in 2004 to 2008, I remember real estate and infrastructure was the sector that had kind of led the first bull run which I saw in my career. When Sensex had actually moved from levels of 10,000 to 21,000, from where we saw global financial crisis. And then after that, we saw a period where pharma and FMCG were two sectors which had led the subsequent bull run. And then, after 2014 elections, we saw financial services and followed by consumer businesses, which kind of, led that rally. Since 2018-19, in fact, post-pandemic, we saw IT, pharma, and then recently commodities kind of, leading the rally. In the similar context, today we want to understand from Anirudh, how does this sector rotation identification happens? What are the various sectors that you and your company and your research is trying to bet upon in the current context of the current decade we are living in, where we see various kind of micro level signals are very much positive. Many businesses are kind of showing great strength, and many businesses are delivering good returns, good results, good profits. But at a macro level, there are various risks and uncertainties. Over to you, Anirudh. We would like to understand from you, in detail, your perspective on market, your view on market, how does rotation strategy works, and hence, what are the sectors that you and your team is looking for.
Thanks, Kamal, and a very warm welcome to all the viewers and investors who are watching this video. I think the way I'll try to have my discussion over the next half an hour or the next 1 hour is, to try to address the first part will be what is the outlook on the market, because I think the way the markets have been moving all over the place, that is something which is on top of everyone's mind. And post that, I'll come to what is exactly sector rotation, how it works, and with some examples, and also what lies ahead. So broadly, if I look at the market, I think I always keep saying this, that there are two pieces in the market. One is events and one is earnings. So these are the two things which drive the market. And I think for the last 6 months, it's been only the events which has taken the center stage. And that is something which I would say has led to the markets moving in all directions, where valuations definitely have seen a decent amount of the valuation correction happening. And at the same time, I think a lot of concern has come in the minds of investors that, is equity a place where I should be? Because I think, what has happened is, in the last 2 years, we have had a good set of investors. So these are the first time investors who have entered the market. And obviously, when they have entered the market in mid of 2020, the next 18 months, they have made excellent returns, which they would not have made in any other asset class. Now that spoils the whole, I would say, approach towards equity, because when you're making 40% annualized return over an 18-month period, definitely, we are not accustomed to seeing a 6-month period wherein you are not making any returns, and practically many people would have lost money also in the last 6 months. So having said that, I would say that one thing always works in the market, which is the mean reversion. And the mean reversion is something which is playing out in the market even as we speak. For the last 6 months, markets have been flat to negative. Obviously, this will be there because if you look at the last 24 months prior to that, you had an annualized return of around 35% in the index. Now, if you go back and see the last 18, 20 years, index has given on an average 14% annualized return, which means this aberration of 35% annualized return over a 24-month period is something which has to go towards the mean, which means you will see maybe 6 months, 9 months, or maybe even 1 year of flattish returns. So that will bring down the average returns. Having said that, I think the last 6 months we had events from elections to the US Fed hikes, inflation, the Russian war, etc. Now, these have definitely made, I would say, the macro environment very, very difficult for companies to operate in. Wherein you have inflation going as high as 6, 7, 8, and even higher percentage, and you have interest rates which definitely are on an upswing across the globe. And obviously, just a day back, we saw how the RBI also gave us surprise hike in India. So I think the next 4 months also investors should be aware of the fact that one should not expect any major big returns in the market. You could see the bounces happen. I think the next 4 or 5 months, you will see the markets remaining in a very, very small range between 16,000 to 17,800. So this could be a very, very broad range in the market. Having said that, I think, as you will find bounces happening in the market because many valuations have become very attractive of companies which, say, even 6 months back, they were quoting at very expensive valuations. Many of them have seen 20-30% kind of a price correction and a valuation correction also. So I think investors looking in the market right now should be there and not move out. They should be there with this view that next 4, 5, 6 months, I don't see any major returns happening. But this should be a time wherein if investors get any incremental cash flows, one should be building a portfolio. The reason for that is that the way I see the markets, I think, beyond this period of next 4, 5, 6 months, once all these macro events get over, the view is that inflation will come off. Now, why inflation will come off? I think the base effect will come into picture. Because if you go back and see, our inflation had started picking up from somewhere around August, September of last year. And in another 4, 5 months, we'll start seeing that high base coming into picture. So in another 6 months, you will find inflation cooling off. One is because of the base effect. And second is also because this whole war around Russia, definitely we don't expect it to continue forever. Definitely it has extended beyond everyone's expectation. But having said that also, I think, we don't expect it to kind of, continue beyond 4, 5, 6 months. And the other piece is China, which has seen some major ports being shut down because of the because of the recent wave of COVID. They are also kind of, on the brink of opening up. In fact, the Chinese economy is slowing down a lot, and there's a lot of pressure internally also to open up things there. So this is the view that, in the next 4, 5, 6 months, you will find inflation cooling off, oil prices coming off, earnings coming back in the floor, and you'll find the margins also improving. Now, that is a time wherein you'll find it difficult to buy. So this is a time over now, as we speak, over the next 1 quarter, to accumulate companies, good quality companies where valuations are on your side, earnings visibility over the next 36 months are there, 24 to 36 months are there. And also, I would say the next 12, 18, 24, 36 months will be a period wherein it would matter what you buy and not if you buy, because the last 24 months, what mattered was whether you bought or not equities. The next 24 months will depend on what you're buying in the market. So that is where I would say the whole sector selection, company selection within the sectors, that will become very, very important. Now, coming to the topic of our discussion, which is, that why sector rotation, because I think, in fact, I've been a believer of sector rotation for a very long time, and I've been practicing it for the last 6 to 7 years. The importance of sector rotation has been amplified in the last 15 to 18 months. And I think as we speak, more and more portfolio managers, investors, and individuals are getting aware of the fact that it is very important to be in the right sector with the right allocation at the right time. Also equally important is to be out of a sector when the sector looks expensive or there are macro concerns within that sector. And that is where I would say sector rotation comes into play. To go back and understand that, why sector rotation works. We are all aware about the economic cycles, and economic cycles are inevitable, whether in India or any other part of the world. I think economic cycles are there. Economic cycles are seen in different sectors at different times. It's not that at the same time you'll find all the sectors going through the same up cycle and the down cycle. So different sectors go through different periods of up cycle and the down cycle. An extension of economic cycles are your earning cycle, which means that as a sector is going through an up cycle, you'll find companies in that sector whose earnings are going up exponentially. And that is a time when you'll find a lot of investors getting attracted to that particular sector. So now the earning cycle, it leads to the valuation cycle. Now, valuation cycle is basically that at the bottom of the cycle, you'll find the valuation of the companies in that sector very, very attractive. At the peak of the cycle, you'll find the valuation of those companies very, very expensive. So these three things work out, which is economic cycle leading to an earning cycle, leading to a valuation cycle. So the idea is that you pick up a sector and obviously the right companies within that sector at the bottom of the cycle. Obviously, you can't get the bottom, but somewhere very close to the bottom, where the valuation is on your side and there's a visibility that earnings are picking up. You ride through that economic cycle, ride through that earning cycle, and you ride through that valuation cycle, wherein something which was fairly attractive, you ride through the P multiple expansion, and you play out the whole economic cycle, earning cycle, wherein the valuation of companies in that sector goes up and they start looking fairly attractive. Now, this valuation cycle was something which earlier used to play out over an 18-month, 24-month, 36-month period, which was very much in line with the earning cycle. But what has changed now in the last so many years is that this whole duration of the valuation cycle has decreased a lot. Something which looks attractive right now, after 6, 9 months, 12 months, it becomes fairly expensive. The reason behind this, and this is not just something which is happening in India, this is happening across the globe. Any sector company which looks attractive becomes attractive to expensive within 12 months. The reason for that is that a lot of liquidity is there in the market and a lot of investors have entered the market. Now, any new idea, any new theme, any new thought process which gets identified, it gets popular very fast. We find a lot of investors entering into that space, and that is the time a company or a sector in that space becomes fairly expensive from being fairly attractive over a 1-year period. Now, this is where sector rotation is important. Now, if I look back in the last 4 bull runs, as we were talking earlier, that, different bull runs have different sectors which lead from the front. If I look at the last 4 bull runs in the market, or maybe the last major upside to the market, obviously going back to the bull run of 99 2000, IT pack was the leader in the pack. And you had the old economic companies like your infra, banking, real estate, metals, which were big time underperformers. You come forward to 2006, 2008 rally. We had the hands changing, wherein the same old economy sectors like infra, capital goods, the real estate, etc., they were the market leaders. They outperformed in a big, big way, and they were the major drivers for the market during that bull run. And you had your defensive consumer growth companies, FMCG companies, which were the major underperformers. As you can see, companies like HUL, which were kind of the major underperformers during that period. If I come to the period just before the pandemic, the period from say 2018 to 2020, you had again the growth-oriented consumption stocks like HUL, Pidilite, Asian Paints, which outperformed hands down the old economy, the cyclicals like your metals, the real estate, banking, etc. Now, within 12 months, you saw the hands changing. Post-pandemic, the same sectors which were underperforming in this period became the market leaders. You had your cyclicals like metals, the real estate, infra companies, power companies, which became the market performers. And the sectors which were the drivers in this period, which is the consumption growth-oriented companies like HUL, they became the underperformers post-pandemic. So what this 4 chart shows is that every bull run or every major upside in the market is driven by different sectors. And that is very, very important that you are there in the right sector at the right time. Also, it shows that the period of this outperformance and underperformance has decreased. Earlier to take 2-3 years to happen. Now we see that changing within 12 to 15 to 18 months, wherein the hands have changed. Now, in this table, what we have tried to show is that if you look at the last 16 years returns, now in this, the numbers which are there in a table are basically the annual returns of these sectoral indices. The last column is basically the 16-year return of these indices. And if I look at the 16 years CAGR returns, except the real estate sector, which is kind of, given a negative CAGR. Except for that, for the other sectors, you'll find the returns are anywhere between 6% and 18%, which is the CAGR returns over a 16-year period. Now, if you look at the returns in individual years, there's a huge variance from this mean, which means that there are individual years when the returns are far, far higher or much, much lower compared to what a 16-year CAGR return looks like, which means that there are times when you need to be in a sector and there are times when you need to be out of a sector also. Now, I have been always a believer of a multi-cap portfolio because I think in a multi-cap portfolio, the portfolio manager or the fund manager, he has the flexibility to move between the market caps depending on the opportunity and the valuation comfort. Now, having said that, if you look at the bottom three rows, this shows the large cap, small cap, and mid cap index returns. Over a 16-year period, you'll find that over a 16-year period, there's roughly around 11% or 12% kind of an annualized return. But again, if you look at the individual returns in the years, there's a huge variation or the huge deviation from the mean. Now, this again shows that there are periods wherein a large cap does well, there are periods when the mid caps do well, and there are periods when the small caps do well. So over a long period, obviously, all of them are giving you similar returns, but definitely in a much shorter period of 1 year, 2 year, 4 years, 5 years, there are definitely the large caps doing better or mid caps or small caps doing better. So that's why we say a multi cap becomes very, very important allocation in a portfolio. Now, this again answers another question that, why sector rotation? Because, when I talk to some investors, and it's a very common belief that, why to take the risk of being into the cyclicals because, their returns are very volatile. I would rather be in a safe sector like consumption, safe sector like pharma, FMCG, where I think the returns are more stable. Now, these four charts, it basically breaks that misconception. Now, the top two charts are basically of metal and banking, and the bottom two are of pharma and FMCG. I think all the four charts look equally volatile. Though the CAGR returns, which is the red band, it is higher for, say, pharma, and second would be banking, and third would be FMCG, and fourth would be the metals. But I think if you look at the volatility of the returns over the 16 years, I think, there are years wherein there's a huge upswing and downswing in the return. So which means that you will see a sharp volatility in the returns, which your portfolio will see depending on how is your allocation towards these sectors. Now, this we basically try to show what are these sectoral returns over the last 6 quarters. And this again shows that over a 4-quarter period or a 6-quarter period, there's a huge volatility of the returns of each sector. Again, a sector which has done exceptionally well for 1 or 2 quarters continues to underperform for the next 4 quarters. Or a sector which has not done well for 1 or 2 quarters, we see that the next 2-3 quarters, they show exceptional returns. So these are again something which brings us to the point that, sector rotation is important. Sector rotation works, and one needs to keep an eye on the sector rotation as and when those opportunities it comes by. Now, you can always say that, Aniruddha, it's good to say all this is good in book, but how do you actually implement it? And have we actually been implementing it in our portfolio? Now, when I look at our portfolios, and we gave some examples from our Quest PMS portfolios, which we manage, and we showed how we would have gone overweight or underweight on some of the sectors during this time frame over the last 2 years. Now, this is a case of us going overweight on the real estate and home improvement sector. Now, the golden line over here, it basically shows the weightage of the real estate and home improvement sector in our portfolio and how it has been increasing. The black dotted line basically shows the the real estate index return, and the blue dotted line shows the Sensex returns, which shows that over the last 2 years, the real estate index has outperformed the Sensex. Now, this shows that the golden line shows that our whole approach of going overweight on the real estate sector was in the right direction. And if you look at our overweight stance from here, like why I'm saying overweight, because index has less than 4% exposure to the real estate and home improvement space. Now, we started building up overweight stance much before the real estate index started outperforming the Sensex, which means we were early identifiers into this sector. Now, I'll just come forward to one slide to show that why real estate, because when I talk about that, we identified the real estate sector early on. A common question which comes, and we thought it would be good to show that that how do you identify a sector, that when is a sector going to be in flavor and out of flavor, because it's not so easy to identify a sector which will do well and a sector which will not do well. Now, one thing I keep telling investors is that it's not just about numbers, because if I just look at the numbers, valuation, etc., definitely then you don't need any human intervention. You just put algos, and the algos will identify which sector to buy when and when to exit. If it was all about valuations, it goes much beyond valuations and numbers. Now, if I give you the example of the real estate sector, now obviously for the last 4 or 5 years, prior to 2020. The real estate sector was a sector which was the most hated sector for obvious reasons, that the sector had not gone anywhere. You had seen a lot of policy changes happening with the implementation of the RERA. You saw price erosion in property prices across India, and all these things were definitely not something which goes down well with investors if you're looking at investing into the real estate sector. Now, when we analyzed somewhere in the months of May, June, July, August, September of 2020, we got attracted with the increase in the registration of the properties across India. Now, that was the first trigger that, the property registrations were picking up. Now, obviously, you cannot base your investment decision just if 1 month or 2 months of registration numbers look very good. We kept a watch on it for almost 4-5 months, and we saw month on month the registrations were going up. Y on Y also the registrations were going up. Now, that got us excited in the space, the real estate space. So when we analyzed, we saw that over the last 6-7 years, the real estate prices in India were practically flat, which you can see with the 1% CAGR return in the real estate prices, which was as good as being flat. So with the property prices being flat for a 6-7 year period, on the contrary, the income growth for the urban population over the 6-7 year period was an annualized 7 to 10%, which means your income has gone up by 7 to 10% annualized, but the property prices which you were looking to buy has remained flat, which means the affordability of those homes has gone up. Another aspect which added to the affordability factor was the home loan rates. Now, home loan rates at 6.5, 6.75% was something which we have never seen in our life. And that was again something which added to the whole affordability factor, wherein you had your property prices being flat, income growth of 7 to 10%, and at the top of it, home loan rates which were at its lowest level in the last so many years. Along with that, what happened is in the last 4-5 years post implementation of the RERA, you saw that a lot of consolidation had happened in the industry, with practically 50-60% of the small builders going out of business. Which means that these were the builders who had to sell their projects under construction to the larger players, or they were forced to form some joint venture with the larger players like your DLF, Godrej, Prestige, Oberoi, etc. And that led to the completion of the projects. And projects which were not getting completed, they saw the end of the tunnel, and the projects got completed. Now, that boosted the sentiment of consumers a lot, that projects are now actually getting completed and I'm able to move in. So obviously the other part was the demand. The demand during the pandemic, it continued to be very, very strong, and we saw that every quarter, every month, the demand was picking up. As the demand for an extra room, a larger house, etc., it went up, and people who were sitting on the fence whether to buy or to rent, they moved to becoming the buyers. Now, all this demand, construction happening, affordability factor going up, property prices remaining flat, home loan rates being low, led to demand picking up, prices also picking up. And another reason for the prices to go up was that you saw the inventory levels coming off in many areas. There were very few launches happening. At the same time, the inventories were getting sold, which means that as your supply decreases, demand picks up, you'll find the prices also picking up. Now that gave us confidence that this is a real estate cycle which is here to stay. This is not just a 1 month or a 1 quarter phenomena. This is going to be a multi-year phenomena. And apart from the real estate, the other piece which we got excited about is the ancillaries to the real estate, which is the home improvement, what we say. And the reason for that was also because that, when you're looking at the real estate companies and the buyers in the real estate companies, we found that this time around the buyers were different from what it was in the earlier cycle. In the earlier cycle, you were finding more of the investors buying the properties. And in this cycle, you found most of the buyers were the end users, which means these are the people who, after making a transaction, will also spend a decent amount on doing up the interiors, which means your demand for appliances, bathroom fittings and of faucets, electric wires and cables, interior decorations, plywood, etc., will also go up. So we took a bet on the entire space, and as we see, definitely the real estate sector has been something which has done exceptionally well over this period. Another example which I would like to show to basically kind of highlight how the sector rotation one can again look at identifying, which is what we again did in our portfolio, which is decreasing financials and increasing IT for most part of the pandemic, and as we speak in the last 6 months, doing a reverse of that, wherein decreasing IT and increasing financials. Now, if I go back in the early days of 2020, our view was that, as pandemic was picking up, somewhere in the middle of 2020, June, July, August 2020, our view was that, this pandemic will definitely take a big hit on the financials. And the reason for that is that, you'll find the banks and the NBFCs having issues with the recovery of loans from the retail side. And definitely there's not going to be much of a growth in the lending. Also, there was no visibility when economy will open up and when the lending growth will pick up. So we went underweight on the financials with all these concerns with us. But at the same time, when talking about where do we go overweight on, we started getting bullish on the IT sector, and that is where we picked up more and more IT, and we increased our allocations significantly because with every quarter passing, with every month passing, we saw that the deal wins for the IT companies was going up. Also, apart from the deal wins, we saw the margins improving, earnings growth picking up, huge hiring happening in the sector. Attritions was also a part and parcel of that. And also the employee costs going up, which are all indications that, the IT cycle is here to stay. It is not just a 1 quarter or 2 quarter phenomena, but this is going to be a kind of a multi-quarter phenomena. So with that in mind, we went overweight on the IT. And again, if you look at the two charts, one is the blue dotted line is the IT index return, and the black dotted line is the banking index return. You'll see that how IT has outperformed banking index by a huge margin. The last 6 months, as I mentioned, that we have reversed this sectoral allocation, wherein we started decreasing our allocation towards IT because of the valuation concerns, and we started increasing our banking and financial allocation. Now, this is something which I keep highlighting, is that just because we went overweight on IT and underweight on banking, it doesn't mean we remain that way for a very, very long time. We have been that way for last 15 months, 18 months, but now with valuations of most IT companies being at the top end of the band, in fact, in some cases even outside the band, and many of the financials and banks and NBFCs being very, very attractive valuation, I think it's a time wherein you need to reverse this overweight underweight stance between IT and financial services. So this is the whole idea around sector rotation, that how and when do we kind of do those sector rotations which are there. Now, another question which keeps coming is that what are the typical, I would say, the themes which you would be kind of looking at, if you're going to do your sector rotation, some of the indicators, which means that what are the parameters which you will evaluate for keeping a tab on these sectors. Now, it's a mix of both numbers and I would say the subjective parameters. Numbers is something which definitely has to be overlapped with the subjective parameters. The examples I gave you about the real estate sector, about the banking and financial, about the IT, it is not something which you can just arrive at those overweight or underweight stance on the sector by just looking at the numbers. You need to also look at the subjective parameters about what is happening on the ground, like the examples I gave for the the real estate sector. We try to put down some of the variables, some of the drivers or the signals, if I have to say, across different sectors, which become kind of the things which you look out for. As an investment house, we and our research team, we spend a decent amount of time in keeping a tab on all these indicators that is the urban or the rural growth picking up, declining, how is income growth happening in that space, which will again give an indication that what is the outlook for the consumption companies or the consumer discretionary companies. Similarly, if I talk about the IT services, how are the deal wins happening? Are you finding the companies having more and more deal wins? Is it big ticket deals or is it the small ticket deals which they are doing? How is the margin outlook for the IT companies? Is it growing? Has it declined? Is it still there's a scope for declining? What would be the impact of a different movement in the currency? How is the hiring trend? Are companies hiring or have they plateaued out? What is the onshore and offshore mix of the company? So these are basically various, I would say, drivers, variables, or signals which we keep a tab on, which gives us an early indication that, okay, it's a time to start looking at this sector if we have been underweight, or it could be a time to decrease allocation to that sector if we have been overweight. Now, an extension of sector rotation is company rotation. Now, this also has become very, very important in the market. As I mentioned that, markets definitely have become such that, a sector or a company from being fairly attractive to becoming fairly expensive, it happens over a very, very short period of time compared to earlier days. Now, when I say short, it is not like I'm talking about a week or a month. I'm talking about anywhere between 6 months to 12 months to 15 months. Now, the reason for doing company rotation is the very fact that all the companies in a sector do not move at the same time. There will be some companies which are better placed, which are, I would say, more attracted by investors, which are on the watch list of most investors. And those companies will be the first ones to outperform or the first ones to kind of, be in the watch list and the investment book of most investors. There could be many companies in that same sector which could be out of flavor because of various reasons in the past. Either it could be some past corporate issue, or could be some past earnings weakness, or maybe some past legacy issue of that company, because of which that particular company could be out of flavor, or it could be at a huge discount to the others in that sector. Now, this is something wherein I would say the contrarian investing comes into play. Now, it's not something which I would say it's very easy to do, because it's very difficult to go contrary to the market view. And definitely it's not always that you will get the best betting against the market. But I think there are definitely many a times you get some of the best wealth making ideas where very few people are looking at. And that is where I would say company rotation helps. If I ended up buying the same stocks which everyone else is buying on the street, then definitely I have to pay a price for it. Because if everyone is buying the same stock, it works in the same way, like when everyone wants to buy the same product in the market, there will be bidding happening at a higher and higher price, and definitely you're not getting it cheap. Then same thing works in the stocks. If you're going to buy what everyone else is buying, you have to pay a premium to it, otherwise someone else will pick it up. So I think we try to look for those mispriced opportunities even within sectors. And there are times wherein you need to move out of a company and get into something else where the valuation, the risk reward is more attractive. Now, if I give you some examples from our portfolio, I'm sure many of our investors who would have interacted with me in the past, they would have been aware of this particular major change which we had done in our portfolio earlier, wherein we moved out of Maruti, which we were holding from say 4,700, 4,800. We moved out of it at around 7,000 odd, and got into a Tata Motors DVR at around 50 rupees. And this chart at the bottom, it shows the outperformance of a Tata Motor DVR compared to a Maruti, which is a huge gap over a 24-month period. If you're able to have such a huge outperformance, then definitely making that switch, it helps. Now, if you look at the company rotation, which we did of getting out of Maruti and getting into Tata Motors, both are in the same sector, both are large caps, both are OEMs, and both were in the passenger vehicle space. Obviously, Tata Motors has both the commercial vehicle and passenger vehicle, and obviously it has a larger portfolio of Jaguar and Land Rovers outside India. But both are OEMs, auto companies, large cap names. And getting this type of outperformance of one over the other, making that switch is something which definitely helps. A similar switch, which we had done in our portfolio of moving out of HDFC Bank and getting into SBI, is again something which has added a lot of value to our clients' overall portfolio returns. Now we had started doing that switch, when SBI was at 160. We gradually decreased our HDFC Bank and went into SBI, and completely once we were able to build our SBI position, we exited HDFC Bank completely. Even from the point when we exited HDFC Bank completely and got into SBI, as you can see in this chart, there has been a huge gap in the returns perspective. And obviously, it's no surprise to people who are there in the market that, this has become a known fact now. Both of them are again into the same banks. Both of them are large cap names. Both of them are well-known names. Again, making that company rotation within the same sector has definitely added alpha to the portfolio. Now, talking about that, why this thing works, because it's good that we have done these things, but why does it actually work? The points which I mentioned, that sometimes what happens is, a company could be a very hot favorite in the street, and everyone is buying it, and everyone is after it, and that leads to the valuations going very, very high. And something else in the space which is being ignored by people on the market, which is not liked by all in the market because of XYZ reasons, that becomes an attractive entry position if you're able to identify that, what are the things which are improving in that company. Same thing, when we did this SBI move from HDFC Bank, I remember when we were looking at SBI, broader view was that just avoid SBI, because, we had just come out of the NPA cycle. And if you would have spoken to anyone on the street, SBI was not on their watch list, because it was like, every quarter they were reporting huge NPA provisions, and there was no end to the bad days. So that is something which gave us the hint that it is a time to look at it, because valuation wise SBI was at 0.4 0.45 price to book, whereas an HDFC Bank was at almost like 2.75 price to book. So there was a huge gap between the two. And obviously we saw signs of SBI's provisions decreasing drastically, the bad loans going to NCLT, the NCLT resolutions happening, and the money is coming back to the balance sheet. So all this gave us a view that ROEs will improve, and ROE destruction was the major concern why SBI saw the bad days, and it was picking up every quarter. As we speak, I think even now, I think the ROE for SBI has come very close to the ROEs for HDFC and ICICI. So that is where, we would say that, to spend time in understanding that something which was bad in the past is coming out of the woods, and it looks good from where we stand at that point of time. So I'll just take a couple of minutes to kind of, speak about some of the sectors which we believe look good from where we are as of today, because I think a very common question which comes to everyone's mind is that, these are what has happened in the past, but what would be the sectors to look out for? I'm sure many of you who are watching this video will be thinking that, which are the sectors to bet on. I think there are some sectors which I see as of now, which are, again, I would put it in that bracket that, they are the hated sectors. Now, one sector I see a lot of potential is the whole agri-economy based sector. I believe agri-economy recovery is a major theme which will play out over the next 1 to 2 years. And that is a theme which will have multi-sectors benefiting. Now, if I talk about the agri-economy recovery, now if you go back and see, agri sector is again something wherein in the last 4 or 5 years, agri income has been very weak. Definitely monsoons have been good, but agri economy recovery has been good, has been bad because of the pandemic. You had concerns with people going back to the villages, and there again, income growth was very very low, and that's the reason you saw that most of the people in the villages, their agri income was extremely low. That impacted the demand environment from that side. Now, the way I see things is that agri commodities have seen decent price hikes. Now, we all talk about the wheat price hike happening, but I think if I look at things beyond the wheat, you have seen a decent price hike even in rice, in cotton, in pulses, in oil, etc. Now, these are all going to translate to higher income growth for the agri side of the economy. And the raw material prices have gone up anywhere between 18 to 20% for the agri economy, and the output of the agri sector has gone up by 30 to 35 to 40% on an average, which means there's a decent gap between the output prices and the input prices for the sector. So I see that the agri-economic recovery is going to be a theme to play out. You'll have the sub-sectors within that. One would be your agri-chemicals. One would be your agri-equipment makers. Another one would be your FMCG companies, which benefit from the agri side income going up. So these could be some of the sectors within the agri-economy theme, which I believe will play out over the next 12 to 18 months. Another theme which I like, which I would say that definitely it's been a lot in the news, but looking at ideas, it's a bit of fragmented ideas over there, which is, I would say, the domestic manufacturing. Now, if I talk about domestic manufacturing, the first thing which comes on everyone's mind is the Dixons of the world, because those become the poster boys of domestic manufacturing. If you're manufacturing iPhone, if you're manufacturing mobile phones, people perceive that that is domestic manufacturing. I would say that there are 14 sectors, 15 sectors where PLI scheme has been announced, and there are enough opportunities over there. These are sectors within the domestic manufacturing theme, which will not kind of show you the numbers overnight, but I would say that over the next 12, 15, 18 months, 24 months, this is one theme which will start giving the dividends. Now, within that, you'll see sectors like, one could be your defense, which will be again a major player. We have seen some amount of that catch up happening in recent times, but if you look at the way it has happened, again, it answers my one point, which I said is that valuation from cheap to expensive happens very fast. Now, defense stocks, if you have been tracking, you will see that from 7, 8, 9p multiple, most of them went up to 15, 16, 18p multiple in a very, very short span of time. It's not that earnings have gone up just because of government announcing a lot of defense projects in the wake of the Russian war. People expecting that the domestic manufacturing of defense will pick up, etc., etc. It led to a lot of investors' money moving into that space, and which has made again those valuations expensive. But yes, that is something which we'll keep an eye on as valuations cool off, as earnings start picking up. I think within the domestic manufacturing, one would be defense, the other would be your auto ancillaries, the third would be, I would say, the chemicals, which is again, I would say, a major theme to play out within a major sector to play out within the domestic manufacturing. So I think there are many such themes which I think one should keep on their watch list. These are the two major themes I find that could give good kind of the wealth creation over the next 12, 18 months to 24 months. The third sector which I continue to be bullish on is the real estate sector. Now, I think, people can question that, with the interest rates going up, will the demand remain strong? I would say that, with the 40 bips, 60, 70 bips interest rates going up, I don't see the real estate demand coming off anytime soon. The reason being that might actually increase the buyers to fasten the pace of buying, because, before the interest rates go up, if there's a trend that the rates are going up, obviously, you would not want to wait for the next 2-3 years for the rates to go to 8-9% if they do happen. But obviously, with that, I don't see with the 40 bips, 50 bips, 60 bips rate hike, you will find the demand going up and demand going down drastically. On the other hand, I would say that with income growth picking up in the economy, with ownership of houses becoming more affordable, I see the real estate cycle continuing at least for the next 6 to 8 quarters. And obviously, you will find the ancillaries to this, your home improvement companies, which will continue to benefit, as we continue to see the demand for the real estate being very, very strong. So these would be some of the sectors, I would say, or the themes which I believe are looking good. And definitely all of them are not contrarian, but I think within the contrarian sectors, one sector which I believe looking good is the whole consumption basket, your FMCG companies, because I think most of them have been plagued with the declining margins, inflation, commodity prices, demand coming off, etc., etc. But because of that, you will see that most of them have given decent price correction and the time correction over the last 6-8 months. So that is broadly from my end with regard to which other sectors which looks good. I'll be more than happy to answer any questions with regard to the market or maybe anything on the portfolio strategy.
Right, Aniruddha. So I think this has been a detailed presentation and very interesting and very, I would say, insightful. There are a lot of questions that come to my mind, and to begin those, I would first want you to explain what, in your view, are the risks in front of us, and if you can maybe convey them in the context of sectors, because we are talking about sectors. So over to you.
See, I would say the biggest risk as of today is that the Russian conflict, it continues much longer, because beyond a point, inflation cannot be tamed by increasing the rates. So what will eventually do is that the Russian war will continue, which will keep the commodity prices high and inflation high. And to address that, you will find the central banks across the globe increasing rates. Now that will hurt the growth, which I think will come to bite us at some point of time. See, unfortunately, the central banks, I wouldn't say they're same for India, but in most of the Western countries, the central banks look very short term. Like we saw what they did during the pandemic, kept on pumping trillions of dollars. And after pumping $4 trillion, they realized we have pumped a lot. So I would say that, the same thing will come to hound them if they keep on increasing the rates in the next 6 months. That, you'll find the growth coming off, you'll find the recession hitting them. And that is the time I would say it will look a bit ugly. And all this, I would say the biggest risk is the Russian conflict continuing for a long time, which many people believe on the, I would say, who are the defense experts, that, it is in the interest of America to keep the Russian war happening for the next 6 to 12 months. So if it happens, I think that's the biggest risk I'm seeing, that, inflation will continue to be high for a long time. Interest rates will keep going up because, the central banks will think that is the way for me to tackle inflation, but it will not yield any purpose. In fact, it was very interesting. Just after the RBI's policy hike, there were some economists who said that the RBI can increase the rates by a couple of more percentage points, but it would not help in bringing down inflation. Now, if you know that the rate hikes will not help in bringing down the inflation, then what is the point of increasing the rates? So I would say that at some point it will come to bite the growth, because you will find the lending growth not happening, capex cycle not happening to the extent it should have happened. So that is my biggest risk. So if you ask me which sectors could get impacted, obviously I would say the infra companies could get impacted, because if the capex cycle doesn't pick up, you'll find infra companies not seeing that private capex. In many cases, in fact, there's concern that many of the government capex projects, there has been a major cost escalation, wherein the projects were launched with say a 5,000 crore budget. Now, because of the inflation in commodity prices, metal prices going up, cement prices going up, oil prices going up, that 5,000 has gone up to 7,000. Now, this is a concern that, with your inflation being high, you could see the infra projects being hit in a big way. And infra, we know, is kind of a major driver for economy. Same thing could apply for the real estate sector. Like, though I'm bullish on the real estate sector, but if you find the metal prices remaining high for a very long time, cement prices being high, etc., you will find that, the construction cost will go up much higher. In fact, even for the current projects under completion, there has been like a 15 to 16% construction cost which has gone up. Now, obviously, you will see some price hikes happening, but beyond the point, they can't keep increasing the prices. Then, you'll find a demand coming off. So these are some of the biggest risks which I see, which could impact, these sectors.
Right, Aniruddha. So, what is your view on IT sector? Despite it's showing good profits, we have seen starting from Infosys and then some of the new age IT businesses like InfoEdge and all. They have kind of, I can say, more or less crashed. They were darlings of equity markets till 3-4 months ago. We did our annual event in February, and biggest thought leaders in the industry who were participating in that annual event, some of the well-known fund managers, they were throughout betting on IT. They were of the view at that point of time that IT is one of the biggest sectors, and one of the fund managers mentioned in that event that IT is like fixed deposit. It's like you can hold on to that because IT is filled with a lot of orders, and profit pools of IT as a sector is going to rise many-fold. And also, it was substantiated that today the allocation towards IT in Nifty 500 is around say 13%, and Nifty 50 is around 17%, versus the top sector as financial services, which is around 30% and 40% respectively. So obviously the gap between financial services and IT will be bridged, and over a longer period of time, IT will actually increase, which sounds very logical, especially in the post-pandemic world, and we are seeing digital revolution going on. Everybody is wanting to adopt IT, but just 2 months after that, Infosys announces a good result, but obviously it is little lower than expectations, and then guidance is also kind of little moderate, and it leads to a fall of 15% and then fall of 20-25% in some of the other stocks. In fact, stocks like HDFC Bank have also kind of risen, after the merger, and then they fell kind of in a crazy way. Obviously, I understand that merger makes a company less scalable, but I would want to hear from you, both on these two stocks, Infosys and HDFC Bank. What is happening in these two companies? What are your views?
See, I would say that earnings wise, I also am very bullish on IT as we speak, because I think, if you talk to the IT vendors, IT companies, and also their customers, I think IT companies will continue to see very strong earnings growth for the next 4 to 6 to 8 quarters. But there are two things to it. One is earnings continuing to grow, and how will the stocks perform? Now, the reason why the IT sector, we also started decreasing. The slide I showed you, wherein we decreased we have been decreasing our allocation towards IT for the last 6 months. The reason being that it's all in the price. Now, valuations have become, all of them, whether it's a large cap IT company, mid cap IT company, small cap IT company, they are all at the top end of the valuation band. Many of them have breached the top end of the valuation band of the last 10-15 years. And that brings me to the point which I mentioned about company rotation, sector rotation, that you need to be out of sectors when the valuations are expensive. You can't be just riding a sector because it's going to do well. That doesn't mean that you keep on hanging on to it for 12 months, 18 months, or 24 months. There is a valuation correction which will happen. You might not see that, because, as you asked me, similar questions, people ask that, Infosys is reporting good numbers, HDFC Bank is reporting good numbers, but then why is the stocks coming off? It's just a valuation contraction which is happening. It's not that, the earnings are declining. It's the valuation contraction which are happening because earlier people were extrapolating the numbers and, paying a high premium to it. But then, after some time you realize that, it's all in the price and valuations are very, very expensive. So I think that same thing has hit HDFC Bank also, which is that, what you have seen is that valuation contraction. Early, the premium which the management used to get, post the management change, definitely you will not find that same premium continuing. And then you start looking at the numbers, when that valuation premium, because the management stays, then you start looking at the numbers and then you realize that, okay, HDFC Bank, ICICI and SBI, they all have a similar ROE profile, etc. They're growing at a similar rate, and the NPA profile also looks very much similar. Then why should it command a premium? So I think it's a valuation contraction which has brought or hurt, all these large cap names in the last 6 months. Having said that, I would say that the next 6 months, you could see some, I would say, because most of the valuation correction has already happened. So now I would say that, many of those will follow in track with the earnings growth. So I don't see any major contraction in the multiples for these names, but I think it will now be driven by only earnings. That P multiple expansion phase is over. In fact, one of our portfolio company which we have is Tata Elxsi, and it has been a 15 bagger for us in the last 18 to 24 months, and we have been taking the profits off the table because at the current price, it's quoting at around 65-70 p, which definitely is not something you can digest for an IT company in India. But I would say that that is where that valuation excesses have been there, and that's the reason you will see that corrections happening.
Sure. And what is your view on HDFC Bank? What's happening in the HDFC Bank? Why stock has corrected so much, despite it announcing a good merger, and then obviously, it went up, made its all-time high, and then from there it has corrected.
See, HDFC has been one of the most overowned stock by all measures. I think, from domestic investors to funds to FIs, it has been the most owned stock ever. So one of the major reasons why, it has seen a correction is because of a large amount of FI exits happening. So obviously, if you remember, I think for the last 4 or 5 years, HDFC Bank used to be always on that FI ban list because it used to be always hitting the upper limit on the foreign ownership. Now that has decreased big time. FIs have been on a continuous exit, and as we know, FIs have been selling across India, and biggest holding being these banks. They were the ones who faced the brunt. The other piece which I said is that premium has gone off. Even domestic investors who are holding it, that premium valuation which you used to command earlier, that is coming off. So my view is that from these valuations, I think over the next 12-18 months, you will find HDFC Bank doing well. Whether the merger, how and when it happens, that is a different piece altogether. But I like at this point of time both the HDFC twins, Limited and Bank, because I think valuations have come to those levels wherein they can be seen to be added in the portfolio. I was not a big fan of HDFC, as you know, for last 2 years. It's only in the last couple of months wherein I've been buying HDFC Limited in the portfolios. And I think that is where I believe the valuation comfort is there. And, the risk reward is on your side at this point of time. I don't see major corrections from here on in both of these.
What is your view, or your personal view or your house view on auto sector, which has actually been laggard for almost 3 years? What is it? What is your sector rotation strategy conveying with regards to auto sector?
See, within the auto sector, obviously, we like Tata Motors, which remains in our portfolio, and it has done exceptionally well for us over the last 2 years. And I would bet on maybe a Tata Motors and an M&M in my portfolio, because M&M would be to play with the agri side of the economy, which I spoke about, the tractor business. Also, there is corporate action expected, as we have been seeing. Is my audio audible?
Yes, Aniruddha, absolutely.
Okay.
Yeah.
I saw my video got stuck, so I was wondering.
No worries. Audio is audible.
Okay. So basically, I think, within the auto, I'm bullish on both Tata Motors and M&M, and I think I would still be with them. I have concerns with the uh, bikes and the scooter makers. The reason being that, I think there's a lot of competition which is over there, especially from the electric vehicles. So that is something which I feel will hurt the Bajaj and the Heroes of the world, because they are yet to get their act on the electric bikes. And I think, with many of the new age companies who are testing and launching their electric bikes, we are yet to see how the disruption in the market happens. Having said that, I would still bet on a Hero for domestic, I would say the agri side of the economy picking up, because penetration of Hero in the smaller towns, villages is higher compared to a Bajaj. So I would say that auto OEMs as a space, I'm quite bullish. Semiconductor shortage is something which has hurt it for a long time. And another hurdle along the way for semiconductors is the Russian conflict, which has increased the waiting period for semiconductors. So I think, as and when this thing gets sorted out, I think we should be seeing a decent amount of bounce back happening, because the waiting period remains very, very long. Even as we speak, the waiting period for, four-wheeler is very, very long. So I would still believe that, it's not a space where I would not be in. Within the autos, I like Auto Anks also, which I think is a part of the domestic manufacturing theme, which is that you could see some of the auto anchors becoming large export centers from India, wherein you could find many of the auto anchors becoming large export becoming large export hubs. So I would say that from current levels, I don't see any major downside, and on the contrary, beyond the time correction, I don't see a price correction in these companies.
So within auto, would you like to also club one of the stocks that you are owning in your PMSs, which has delivered very well, which is Tata Power? And would you like to give some perspective on that also?
So Tata Power, I would say that basically it's one of the best ecosystem you can play for the electric vehicles, because I think Tata Power. When we also looked at it, it was not just about the power business. It was for multiple things. One was the reduction in debt. Second was almost 30% of its energy coming from the solar energy, and the third was its electric vehicle charging ecosystem, which it was putting up in the country. So I think it's a good play from that angle about the whole electric vehicle charging ecosystem which it is putting up, and also the solar energy portfolio, which I think in the next 5-6 years it has the potential to become a very, very large solar energy provider in the country. So that is something. And the other piece to Tata Power is that they are doing many joint ventures with the auto OEMs, wherein they would be putting up. In fact, they have been doing some JVs with the real estate companies also, wherein they would be putting up the charging stations in the real estate complexes. So I think it becomes a good play on the whole EV charging ecosystem, wherein they are doing JVs with both auto OEMs as well as the real estate companies.
Right. So, to everyone who has joined us today, I would just like to give one disclaimer that we have tried to deep dive the subject of certain stocks and various sectors in line with the theme of this webinar, because Quest Investment Advisors has recently, launched one of the alternative investment funds, which is based on sector rotation strategy, and is trying to generate alpha by following the sector rotation strategy. And that is where we thought that let's discuss with Aniruddha, who is the fund manager, to understand his ideology, perspective, and the process that they follow. In that context, we are kind of trying to understand, to educate ourselves, and hence any of these talks that we have discussed must not be construed as any kind of advice. It's only for education purposes. So, taking our discussion ahead, Aniruddha, I would like to understand, from you now, in the context of the sector rotation fund and the research that your team has been doing, especially after we have seen the hikes announced, and we know that the kind of liquidity stance that RBI has and Fed has for the financial year which has just begun. What are the top three sectors that your fund is going to ultimately deploy the investor money into?
See, I would say that obviously, as and when, because in the fund also we are taking the money in different tranches, and initially we are just taking 30% is the initial drawdown, and the plan is to take the money over the next 6 to 9 months. We would also not be in a hurry to buy into all the sectoral themes which we like, because I think it's very important that at what valuation you are getting which sector and which company. But having said that, I would say the initial few themes would be like the ones which I mentioned, which is one is your agri-economy recovery theme. Second would be the real estate theme. And the third would be your domestic manufacturing theme. So these would be kind of the three themes which we believe have a good potential at this point of time. Financials, yes, I think financial penetration / deep valuation of financials could be another kind of a sectoral theme which we look at. But as I mentioned, it would be dependent on as and when we take the drawdowns and what looks like good at that point of time. Because in the fund, what we are doing is we are playing with only 4 themes at any point of time, and the fund would be focused on only 4 themes at any point of time. And the idea is that any new theme which we want to add in the portfolio. One second. Yeah. So basically, the fund would be focused on the sector rotation and company rotation, which I spoke about. And at any point of time, the fund will have max to max 4 themes. Now, a theme should be seen different from a sector. A theme could have some some sub-sectors, like, like I mentioned about agri-economy, having agri-chemicals, agri-equipments, FMCG, etc. So there will be only 4 themes at any point of time. A fifth theme which we identify, if it enters, it has to replace one of the existing themes. So it's not that, eventually it will not look like a similar, like a like a, a mutual fund portfolio. It will be a concentrated 15 to 20 stock portfolio. The reason being that in any theme, max to max 5 stocks will be bought, which means with 4 themes, max will be around 20 stocks which you're buying, which means that, it'll be a pretty concentrated portfolio of 15 to 20 stocks spread across max to max the 4 themes which are there. Another thing which we'll be doing very, very actively in the portfolio is the cash call. Now, it's a very, very difficult call, which is the cash call. Now, the idea is that, the fund is for 48 months. And during the next 48 months, obviously, we have elections in India, which is a major, major event. And also there is no shortage of macro global events like war, conflicts, etc., etc. So if there comes upon a time that, we find one of the themes which we have out of the 4 themes, it looks very, very expensive, and we want to exit that theme, but we are not getting any better idea to invest into, we don't mind keeping cash of 25, 30, 40% also in the portfolio. So idea is to look like an absolute portfolio returns and not to just kind of, hug the benchmark. So it'll be a slightly more actively managed active fund.
Last question to you. Everyone, when we ask this question about favorite sectors, everybody talks about financial services, and now you also mentioned, given the valuations, given the I would say the possibility of financialization as a theme, and the scope of further financialization in this decade. Financial services is a theme which cannot be avoidable. And within financial services, you have bet on bank like SBI and ICICI Bank. And at the same time, you're also talking about some of the sectors like infrastructure sectors getting negatively impacted because of inflation and increase in interest rates. So a sector like a bank like a corporate bank, SBI is a corporate bank, and ICICI is also a corporate bank, versus maybe HDFC and Kotak, which are more of a retail banks. Don't you think your view is contrarian in the sense that on one side you are of the perspective that some of these sectors which are sensitive to interest rates and inflation will be negatively impacted. On the other side, some of these banks who must have lent to infrastructure, must have lent to some of these companies which are interest rate sensitive, you are holding in your portfolio.
So I would say that, the profile of these banks have changed a lot in the last so many years. In fact, very few people are aware that, HDFC Bank is the largest corporate lending bank on the MSME. On the MSME, HDFC Bank happens to be the largest corporate lending bank on that side. At the same time, someone like an SBI, with the usage of its online app platform, which is the Yono, they have been able to become the largest and the fastest growing the loan disbursement for the retail sector in the last 18 to 24 months, wherein physical branch visit was not possible. And a bank like SBI with that large customer base had an app like Yono, and which made access to financials by the retail population very, very easy. So I would say a lot of profile change has happened for all these banks. HDFC, which was typically perceived to be a retail bank, has got a decent amount of corporate book. SBI or an ICICI, which was perceived to be more of a corporate bank, have got decent, I would say, share of the retail book. So having said that, I would say that if the infra concern, which I'm talking about with inflation going up, it actually pinches with the projects not happening, then definitely it will pinch, the entire banking sector. But having said that, the other piece to it is that, if there's a increase in the financial, the cost of a project, the lending will go up. Like say SBI is financing, say for example, an airport which is being built by say Adani Group, and they have planned for say 7,000 crore funding of that project. Now tomorrow, if that project cost from 7,000 goes up to 8,000, definitely it's it's a good thing for someone like an SBI, wherein your lending has gone up because of that particular thing. Definitely, if the projects get cancelled altogether because of very, very steep hike, that is something which will become a concern. But I think that is something which I don't see it happening immediately at this point of time. But since you had asked me that, what could be the biggest risk in the economy, I would say that that is a risk, wherein that, if inflation continues to be high for a very, very long time and we find growth coming off, then, definitely capex cycle could get impacted.
Right, Aniruddha. So going by the last 2 years returns till 31st March, because data, for PMSs is available to 31st March as of now, it is actually, very rare, I can tell you, because 2 years ago, as of 31st March 2020, index Nifty was at a level of around 8,000. And on 31st March 2022, it was at a level of 17,500. So there are very, very rare PMS strategies which have actually outperformed the index if when one compares on 2 year basis. And many strategies, many PMSs which talk about buy and hold, and they have actually grossly underperformed, not marginally, but very badly underperformed. But Quest Investment Advisors multicap, PMS I have seen has actually outperformed, and it's not marginally, but it's meaningfully, outperformed even in last 2 years. Obviously, it has outperformed in 3, 5, 7 years also, but it has also outperformed in last 2 years. I think it is purely to do with the right sector rotation strategy that Aniruddha and his team has been following. Aniruddha, any last words, on what kind of guidance you want to give to the investors who are already invested in your strategy and who are looking to kind of seriously consider sector rotation strategy?
See, one thing which I keep telling to investors, both existing and the new investors, is that one should come to equities not with a 6-month horizon, because I think, in 6 months, anything can go wrong anywhere in the world. But if you have an horizon of 24, 36, 48 months, I think there is no other asset class which can give you a mid-teens to high-teens type of an annualized return. And I see the same thing happening even for equities at this point of time. Obviously, we have all the clouds of pessimism around us with inflation, Fed hike, RBI hike, Russia war, etc. Around us. But, historically, if you go back and see the last 15 years or 20 years data, it is only after when you have so much of pessimism that the next 24, 36 months have given you supernormal returns. So I would say that investors should remain invested at this point of time. It is not a time to take off money. It is a time to actually, if you have incremental cash flows, it's a time to allocate money, whether into PMS, direct equity, mutual fund. Obviously, your PMS world is one of the best advisors to such allocations. But I would say that it is a time to be invested and allocate money. It might sound very cliche that, every fund manager says the same, but I think that's a fact of life, that, it is only during such bad times that, you get valuation on your side. Otherwise, you would have to buy a Bajaj Finance at 8, 9 price to book, and you're getting it now at a 6.5 price to book. So definitely, when valuation comes on your side, it is not a time that you sell Bajaj Finance at 5,900, and there were buyers of Bajaj Finance at 8,900. So I think, that answers it, that, it's a time to buy, not to sell.
Absolutely. And, to add to what Aniruddha has mentioned, we at PMSI World convey to our clients who want to take a decision of investing now, despite markets have fallen, or maybe have been investing over last 6 months, seeing the fall in the markets, or investors who are looking to do any top-ups in their existing investments. We would want investors to keep a minimum horizon of 500 days, because this objective number makes your decision making easier. If you can actually, ask yourself that, or convince yourself that I will not be bothered about what is happening in the market. I will not be bothered about comparing the performance of my portfolio with the benchmark in the first 500 days period. Then obviously, the time value of money would creep in, and the underlying businesses eventually over that 500 days period would have created so much earnings that as the sentiments kind of, becomes favorable to equities, it will outshine. And obviously the good portfolios, good companies, the underlying portfolios will absolutely, perform and give alpha. This is exactly, what happened in last 40 years of equity markets, and this is exactly what will happen in next 40 years of equity markets. So it is absolutely important to have a patient long-term approach. And obviously, some of the strategies that we have been bringing for you, like West, investment advisors, their Smart Alpha fund are obviously, some of the credible portfolios which are very well regulated by SEBI and come with very credible teams and also follow a process. And obviously, handling to some of these fund managers makes the life of investors easier and gives them a lot of comfort. And that is where we promote some of these PMS and AIF strategies. Thank you, everyone, for joining us today. And thank you, Aniruddha, for taking out time. Thank you, everyone.
It's a pleasure always.